In terms of policy, the Fed has implemented a dovish pivot with likely rate cuts over the next 12 months. We expect balance sheet roll-off to persist over the medium term. We expect the Treasury to offset balance sheet roll-off via its low net bond supply financing regime until the RRP balance is largely depleted. The drain in the RRP increases U.S. dollar liquidity and coincides with rising global liquidity.
Textbook core PCE deflation is supportive of market expectations for rate cuts throughout 2024. And what we mean by textbook is we have the 3-month annualized rate of change, which is a 2.3%. These blue bars is below the 6-month annualized rate of change of 2.5%. That's the black line. And the 6-month annualized is below the year over year. So we know that there's disinflation momentum in the pipeline. If we do nothing, if we just stay at 2.3 3-month annualized, we're going to continue to see the 6-month annualized and the year-over-year rates of change trend lower, which is exactly what the policymakers want. If they continue to see that, they're going to feel comfortable and confident that inflation is moving according to what they need it to do. They're not going to overreact to 1 month of hawkish data, in our opinion, just given the policy guidance. They're asymmetric policy guidance. These guys they're not itching to cut, but they're more sensitive to economic deterioration than they are sensitive to, data that, indicates that the economy's really super resilient and going to no land. This is a Federal Reserve that probably should have hiked interest rates after that Q3 GDP report. They did not, but they're probably on their way to cutting interest rates if we continue to see inflation move in the way that it does. Perhaps not as early as the March indication in the markets, but certainly, perhaps certainly by the second half of next year.